In this video, we are going to talk about best investment to make while you are young. So before starting, please like this video and subscribe to this channel for our future updates. Young people who are interested in starting a savings plan confront a bewildering number of financial possibilities to choose from. In addition to the hundreds of items and services available, there are almost as many distinct businesses and vendors that promote them in a variety of roles. The good news is that putting your money to work is not quite as challenging as it might first appear. Here are 10 best investment to make while you are young. So let's start. Number 10. Saving for retirement. Time and compound interest are your most significant financial assets when young. Long-term investments should prioritize growth at this point in your life. 20-something who start saving for retirement have at least 40 years to do so. To maximize returns, you should invest most of your money in equities, such as common stocks or stock mutual funds. You might potentially buy a home for your family or a REIT, a mutual company that invests in real estate. Because you'll need every penny once you retire, it's crucial to grow your retirement savings over time. Lifelong buying power growth of retirement funds is crucial. Number 9.40 WICs and IRAs. IRAs and IRPs are great retirement savings vehicles. Employers may match retirement plan contributions. This can significantly enhance retirement savings. A matching contribution of 50% of the first 5% of your donations can add tens of thousands to your retirement savings. Most financial advisors recommend Roth IRAs for younger people. Despite not receiving a tax benefit for your contributions, they and their earnings will grow tax-free until retirement, and withdrawals will not be taxed. 400 and ONIC plans include Roth account investment options. When you retire and remove money from traditional IRAs and 400 and WICs, the money is taxed at the same rate as your personal income tax, and you must withdraw a certain amount starting at 72 as of 2020, regardless of whether you need it. The Roth IRA's tax-free growth with no withdrawals and equities investments' higher earnings make it hard to beat over the long term. Number 8. Buying a home. A home is often considered one of the best investments, although this depends on a number of things. This depends on the length of your stay, the home market, interest rates, rental rates, and your finances. If you plan to stay in one place for less than 5 years, it takes 5 to 7 years to build enough equity to make buying a property more financially advantageous than renting. Number 7. Buy fractional shares of a stock or ETF. Today, you don't have to buy all stock or ETF shares. If you wanted to invest but can't afford much stock, consider fractional shares. This is when you buy a stock for a tiny amount. You desire Netflix shares but can't afford $500 per share. Instead, pay $20 to buy a modest share of that one. Fractional shares give you corporate ownership. Investing applications and brokers don't sell fractional shares. Public.com, a great commission-free stock and ETF trading app for iOS and Android, lets you buy fractional shares. It allows fractional stock and ETF purchases. Number 6.529 plans. Every state offers college savings plans. It now includes K-12 private school, but you probably won't mind. The money can be invested in many ways and will grow tax-free until it is used for qualified higher education fees. These plans' high contribution caps can save rich contributors gift and inheritance taxes. Number 5. Buy a home. Next, property ownership builds equity. Rising house values and slow mortgage payments cause this. Homeownership gives leverage. A $300,000 house can appreciate for $9,000 with 3% down or no down payment with a VA loan. Your $9,000 investment will be $300,000 in 30 years. 33-fold your initial investment. Property price appreciation might boost it. Homeownership may not benefit young buyers. Move early in your career. Homeownership may hamper moving. Singles can't afford homes. Marriage may require a move or purchase. Number 4. US savings bonds. These are yet another alternative to consider for conservative investors who don't want to risk their principal. The interest that they earn on US savings bonds is also tax-free as long as it is used for higher education expenses. Number 3. Short-term investments. Emergency finances are same regardless of age. Savings, money market funds, and short-term CDs safeguard idle cash. Most experts advocate 3 to 6 months of living expenses in these assets, depending on your financial situation. Young investors should realize that over a long period of time, like their working years, market tracking ETFs and dividends and interest almost always trump short-term stock trading. Despite significant profits, day traders fail. Worst case, they lose their principal and owe brokerage interest on margin trades. Number 2. Invest in the S&P 500 index funds. Young investors should prioritize growth assets. Because growth investments compound much faster than safe, interest-bearing ones in the decades ahead. S&P 500 returns 10% yearly since 1926. That's massive compounding. Despite the coronavirus's rapid spread, young investors should buy stocks. Discounted top stocks. You can also survive stock market lows. Don't invest needed funds. Number 1 point: invest using robo-advisors. We considered commercial real estate rights and S&P 500 index ETFs. Robo-advisors are good for inexperienced investors. Automated investment platform. Portfolio management. They reinvest dividends, alter your portfolio, and offer tax strategies to lower investment gains. Robo-advisors manage IRAs and taxable investment accounts. Simplest investing. After funding, the robo-advisor takes over. They mix stocks and bonds. ESG stock funds abound. Investor Junkie likes Wealthfront and Betterment, the largest independent robo-advisors. Industry leaders both offer great investment rewards. Save early. Investing matters more than investing in. Your best investments depend on your goals, risk tolerance, and timeline. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.